In December 1963, thousands of workers in South Bend, Indiana, discovered that a promise they had trusted for decades could disappear almost overnight. They had spent their working lives inside Studebaker's factories, trusting that loyalty would be rewarded with a dependable pension. But when the automobile plant closed, the retirement fund was revealed to be dangerously underfunded. Much of the promised money was not there. The collapse would eventually help force Congress to regulate private pensions. It would also set in motion a chain of reforms that made traditional retirement benefits more expensive for employers and prepared the way for a radically different system. That system was the 401k. Today, tens of millions of Americans rely on these accounts. Yet the 401k did not emerge from a national plan to guarantee retirement security. It began as an obscure tax provision transformed by an interpretation its authors had not clearly intended. To understand why that accident became the foundation of American retirement, the story has to begin in a world where retirement barely existed. For most of history, people did not leave the workforce because they reached a designated age. They worked while their bodies allowed it. When they could no longer continue, survival depended on family, charity, property, or luck. At the beginning of the 20th century, average life expectancy in the United States was roughly 47 years, partly because infant and childhood mortality remained high. Many people never experienced an extended old age. Those who did often had no independent income. In rural America, the family itself functioned as the closest thing to a retirement system. A farm was an intergenerational arrangement. Children contributed labor, then assumed more of the burden as their parents aged. Older family members remained on the land, receiving food, shelter, and care from the household they had built. The arrangement could be harsh and unequal, but it provided a structure. Industrialization weakened that structure. During the late 19th century, factories, mills, railroads, and mines pulled young workers toward expanding cities. Pittsburgh, Cleveland, Chicago, New York, and other industrial centers offered wages that could not be earned on many small farms. Families that had once remained geographically connected were scattered across states and regions. The same transformation that created modern industry also separated aging parents from the children who might once have supported them. For elderly Americans without savings or nearby relatives, one institution remained, the poorhouse, also known as almshouses. These facilities had existed since the colonial period. Local governments used them to contain nearly everyone who could not support themselves: the elderly, people with disabilities, widows, orphans, the sick, and those suffering from mental illness. They were not designed to provide dignified retirement. They were designed to manage dependency as cheaply as possible. Residents, commonly called inmates, slept in crowded rooms under strict rules. Medical care was limited, privacy was rare, and conditions were often appalling. The fear became embedded in American culture. Will Carleton's Over the Hill to the Poorhouse told of an abandoned mother making the journey to an almshouse. Its popularity reflected a shared anxiety. Surviving into old age could mean becoming a burden and losing autonomy. Over time, reformers moved children into orphanages, prisoners into penal institutions, and many psychiatric patients into asylums. The elderly, however, remained. By the late 19th and early 20th centuries, almshouses increasingly functioned as institutions for aging people who had nowhere else to go. America's earliest widespread retirement facility was therefore not a pension-supported community. It was the last stop of the poor. The stigma was deliberate. Public assistance was structured to be unpleasant enough that only the desperate would seek it. Poverty in old age was often treated as evidence of personal irresponsibility rather than the predictable result of low wages, illness, economic crisis, or a lifetime without access to savings. Mutual aid organizations offered a more humane alternative, but only to limited groups, religious communities, ethnic societies, unions, and fraternal orders collected dues from members and used the funds to provide assistance during sickness, unemployment, death, or old age. Irish benevolent associations, German mutual aid groups, Jewish charitable organizations, the Odd Fellows, the Masons, and numerous churches established homes for aging members. These institutions showed that retirement security could be organized collectively, but protection depended on belonging to the right group. There was still no broad system covering the workforce. The first major corporate experiment appeared in 1875. American Express, then closely associated with freight and railroad operations, created what is generally recognized as the first private pension plan in the United States. Eligibility was restrictive. Workers needed at least 20 years of service, had to be 60 or older, required a manager's recommendation, and still needed approval from a committee of the board. Those who qualified could receive half of their annual pay, subject to a maximum benefit of $500 a year. The plan covered few workers, but its underlying principle was significant. A corporation was acknowledging that its responsibility to an employee might continue after the employee's productive labor had ended. Other large companies gradually followed. Standard Oil, U.S. Steel, AT&T, Eastman Kodak, Goodyear, and General Electric introduced pension programs before 1930. Federal tax policy encouraged the trend by allowing favorable treatment of employer contributions. Even so, pensions remained exceptional. By the mid-1920s, only a few hundred private plans existed. In the early 1930s, roughly 15% of workers had access to a company pension. Most Americans still faced old age with little beyond personal savings and family support, and even those covered by pensions possessed fewer protections than the word pension implied. Employers controlled the plans. Companies could set demanding service requirements, dismiss workers before benefits vested, alter the rules, or terminate the plan. There was no comprehensive federal requirement that promised benefits be fully funded. A pension could appear in recruitment materials and company speeches without enough money being reserved to pay every future retiree. Workers were asked to trust the longevity and good faith of their employers. Then the Great Depression shattered trust across the entire economy. After the stock market crash of 1929, banks failed by the thousands. Between 1930 and 1933, more than 9,000 American banks suspended operations. Because federal deposit insurance did not yet exist, depositors could lose everything when an institution closed. The collapse punished people who had followed the rules. Savings disappeared, businesses failed, property values fell, and unemployment reached catastrophic levels. Older workers were especially vulnerable. Employers often dismissed them first and rehired them last. Many had neither the time nor the physical ability to rebuild their savings. By the middle of the Depression, approximately half of elderly Americans lacked the income or resources to remain financially independent. The older system, family support, charity, local relief, and the almshouse could not absorb suffering on that scale. Younger relatives were unemployed. Municipal governments were overwhelmed. Private charities exhausted their funds. Old age poverty was no longer possible to explain as a collection of individual failures. It had become a national emergency produced by a national economic collapse. Franklin D. Roosevelt's administration responded by redefining the federal government's role. On August 14, 1935, Roosevelt signed the Social Security Act. The law created a nationwide system of old age insurance financed through payroll taxes paid by workers and employers. For the first time, the federal government promised recurring retirement benefits to broad categories of American workers. Eligibility would be earned through participation in the labor force rather than granted through local charity. The original system was narrower than the modern program. It excluded many agricultural laborers, domestic workers, and self-employed people. Those exclusions disproportionately affected Black Americans and women. Monthly payments did not begin until 1940, and early benefits were modest. But the political and psychological transformation was profound. Old age was being recognized as a predictable phase of life that could be insured collectively. A worker who paid into the system would possess a legal claim to benefits. Support would no longer depend entirely on children, employers, or the discretion of local officials. Social Security also served an economic purpose during the Depression. Retirement benefits placed money in the hands of people likely to spend it quickly, while encouraging some older workers to leave the labor force and create openings for younger job seekers. The program expanded. Amendments in 1939 added certain spouses, children, and survivors. Disability insurance followed in the 1950s, and Medicare added health coverage for older Americans in 1965. Yet Social Security was never intended to finance a comfortable retirement by itself. Policymakers increasingly described retirement security as a three-part structure: government benefits, employer pensions, and personal savings. Social Security would provide a floor. A pension would replace part of a worker's salary. Savings would cover additional needs and unexpected costs. In the decades after the Second World War, that model appeared to be taking hold. American industry expanded. Union membership was strong. Wages rose, and large corporations competed for skilled workers. Defined benefit pensions became central to collective bargaining agreements and corporate employment packages. Under these plans, the employer promised a specific benefit, often calculated through salary and years of service. The company was responsible for investing the pension fund and ensuring that enough money existed to make payments. For workers at manufacturers such as General Motors, Ford, and U.S. Steel, the arrangement offered something earlier generations had rarely possessed: a reasonably predictable exit from working life. By 1970, around 45% of private sector employees participated in some form of pension plan. This period created the enduring image of retirement: a gold watch, a monthly pension check, Social Security, and time away from work. But the security was less universal than nostalgia suggests. Millions of workers remained uncovered. Many plans required long periods of service before benefits became vested. Changing jobs could mean losing years of accumulated pension value. Most dangerously, a promise on paper did not guarantee that sufficient assets existed behind it. The weakness remained hidden while companies were profitable and expanding. It became visible when an employer declined. Studebaker offered the clearest warning. The company had begun in the 19th century as a wagon manufacturer. It supplied vehicles during the Civil War and later entered the automobile business, becoming one of the country's best-known independent car makers. By the early 1960s, however, Studebaker was losing its struggle against General Motors, Ford, and Chrysler. Sales weakened, costs increased, and its South Bend operations became unsustainable. Behind the deteriorating business stood another liability. The pension plan for hourly workers did not contain enough money to cover all the benefits employees had been promised. When Studebaker closed its South Bend automobile plant in December 1963 and terminated the plan, the losses were distributed according to age and status. Around 3,600 people who had already retired largely retained their benefits because annuities had been purchased for them. But approximately 4,000 workers between 40 and 59 received only a small fraction of what they had expected, roughly 15 cents for each promised dollar. Their average age was 52. And they had worked for the company for an average of 23 years. Another 2,900 employees with fewer than 10 years of service received nothing. The workers had not lost money through reckless investment decisions of their own. They had fulfilled their side of an employment bargain. The company had promised future security without adequately financing it. Studebaker revealed that America's pension system rested on a dangerous contradiction. Retirement benefits were presented as earned compensation, but federal law still treated many of them as promises that could collapse with the employer. The disaster in South Bend did not immediately transform the law, but it gave pension reform a human face, and it placed a question before Congress that could no longer be ignored. If a worker could give a company the best decades of his life and still lose almost everything at the end, what did a pension promise actually mean? The failure at Studebaker exposed more than one badly managed retirement fund. It revealed that the promise of a pension could vanish precisely when workers needed it most. For years, employees had treated retirement benefits as deferred wages, compensation earned through decades of service and loyalty. Employers often presented pensions in the same way. They were used to recruit workers, discourage them from leaving, and reward those who remained with the company. But legally, those promises occupied uncertain ground. A company could operate a pension plan without setting aside enough money to meet its future obligations. Workers might spend 20 or 30 years accumulating expected benefits without gaining an absolute right to them. If the company failed, changed the rules, or terminated the plan, employees could discover that the retirement income they had built their lives around existed largely on paper. The Studebaker collapse made that danger impossible to dismiss. Senator Jacob Javits of New York and other lawmakers began pushing for federal protections. The effort encountered years of resistance. Pension regulation crossed the jurisdictions of several congressional committees. Employers warned that strict requirements would make plans too expensive. Labor organizations supported stronger protections but disagreed over details. The financial industry had its own interests in how pension assets would be managed. Scandals added pressure. Misuse of union pension funds, including abuses associated with the Teamsters, demonstrated that workers could be threatened not only by corporate failure, but also by corruption among those responsible for safeguarding their money. Still, reform moved slowly. More than a decade passed between the Studebaker shutdown and a comprehensive federal response. On September 20, 1974, Labor Day, President Gerald Ford signed the Employee Retirement Income Security Act. ERISA transformed the legal status of private retirement plans. The law established standards for participation, funding, disclosure, and vesting. Employers could no longer make unlimited promises without meeting basic financial requirements. Workers had to receive clearer information about how their plans operated and when their benefits became legally theirs. The legislation also created the Pension Benefit Guarantee Corporation. The PBGC functioned as a form of insurance for traditional private pensions. Employers sponsoring covered plans paid premiums into the system. When a company terminated an underfunded pension and could not meet its obligations, the agency could assume the plan and pay benefits up to statutory limits. The protection was not unlimited, but it changed the balance of risk. A future Studebaker could no longer leave every affected worker entirely dependent on whatever money happened to remain in the pension fund. ERISA addressed a genuine injustice. It also altered the economics of employer-sponsored retirement. Traditional pensions had once allowed companies considerable flexibility. Benefits could be promised today while much of the cost remained decades in the future. ERISA made those obligations more visible, regulated, and expensive. Companies now faced minimum funding rules, administrative requirements, reporting duties, insurance premiums, and potential liabilities when investment returns failed to match projected benefits. Employers could no longer treat pension obligations as loosely defined commitments. For workers, these protections were essential. For corporations, they created an incentive to search for a different model. The traditional pension was a defined benefit plan. It promised the employee a particular result, usually a monthly payment calculated through salary, age, and years of service. The employer was responsible for accumulating enough assets to produce that result. If markets performed poorly, retirees still expected their checks. If employees lived longer than projected, the company still owed the benefits. If interest rates fell and the pension fund's liabilities increased, the employer might have to contribute more money. The central risk rested with the institution. Companies increasingly preferred a system in which their responsibility could be determined in advance. Instead of promising a lifetime payment, an employer could place a defined amount into an individual account. Once the contribution was made, the future investment performance would no longer be the company's obligation. That alternative did not arrive through a carefully designed national retirement strategy. It emerged from the tax code. In 1978, Congress passed a broad piece of legislation known as the Revenue Act. Buried among its many provisions was a relatively short addition to Section 401 of the Internal Revenue Code. Subsection K, the language addressed cash or deferred compensation arrangements. These plans allowed certain employees to choose between receiving income immediately or deferring it under favorable tax treatment. Congress was primarily concerned with regulating arrangements that could disproportionately benefit executives and highly compensated employees. The provision attracted little public attention. It was not presented as the foundation of a new retirement system for ordinary workers. Its importance became apparent only after someone interpreted it differently. Ted Benna was a benefits consultant working in Pennsylvania. In 1979, while studying the tax code for a client, he examined the newly added subsection and saw a possibility others had overlooked. The language appeared to permit employees to direct part of their salaries into a tax-deferred plan. Contributions could be deducted before income taxes were calculated, and employers could encourage participation by adding matching funds. Nothing in the provision clearly announced that Congress intended to create a universal salary deferral retirement account, but Benna believed the language could support one. It was an aggressive reading of a technical rule. His client declined to adopt the proposal, reportedly concerned that tax authorities might reject the interpretation. Benna instead introduced the design at his own firm, the Johnson Companies. The structure was straightforward. An employee could choose to place part of each paycheck into an individual retirement account before paying income tax on that money. The employer could match some portion of the contribution. Funds could then be invested, allowing gains to accumulate without immediate taxation. Taxes would generally be paid when the money was withdrawn. The arrangement offered employees an immediate incentive to save and gave employers a retirement benefit whose cost could be controlled. In 1981, the Internal Revenue Service issued regulations confirming that salary reductions could be used to fund these plans. The obscure subsection now had official backing. Major corporations moved quickly. Johnson & Johnson, Honeywell, PepsiCo, and other employers began establishing 401 Kile programs. Benefits consultants promoted them. Mutual fund companies created investment products for them. Banks, insurers, brokers, and record-keeping firms developed an industry around administering the accounts. What had begun as a narrow provision became an expanding financial market. The appeal to employers was powerful. A pension required a company to manage a pool of assets for the benefit of present and future retirees. The final cost could not be known with certainty. A 401 Kile, by contrast, converted retirement into a series of current contributions. An employer could promise to match a percentage of an employee's salary. Once that money entered the account, the company's responsibility was largely complete. There was no guaranteed monthly payment. There was no obligation to replace a fixed share of the worker's former income. There was no requirement that the accumulated balance last for the rest of the employee's life. The obligation became limited. The uncertainty moved elsewhere. It moved to the worker. In a 401 kilo, employees had to decide whether to participate, how much to contribute, which investments to select, and when to adjust their portfolios. They had to avoid withdrawing funds early, resist panic during market crashes, estimate future inflation, and determine how much money would be required for an unknown number of retirement years. A defined benefit pension asked a worker to remain employed long enough to qualify. A defined contribution system asked the worker to become a long-term investor. The transformation occurred gradually enough that many employees did not recognize its full significance. Initially, 401k plans were often described as supplements. A worker might receive Social Security, a traditional pension, and additional savings from the new account. In that arrangement, the 401k could strengthen retirement security. But as corporations adopted the new plans, many froze or eliminated their pensions. New employees were placed in defined contribution systems, while older workers sometimes remained under legacy arrangements. The three-legged retirement stool began to change. The government continued to provide Social Security. Personal savings remained important. But the employer pension, the leg that guaranteed income for life, was replaced by an account whose value depended on contributions and market performance. The numbers reflected the shift. Traditional private sector pensions reached their high point during the 1970s with tens of millions of active participants. Over the following decades, participation declined sharply. Defined contribution plans moved in the opposite direction. Millions of workers entered 401ks and similar accounts. By the 21st century, they had become the dominant form of employer-sponsored retirement in the private sector. For corporations, the transition reduced long-term exposure. For Wall Street, it created an enormous and continuous stream of investable money. Every pay period, employees across the country directed part of their wages into mutual funds, stocks, bonds, and other financial products. Employers added contributions. Asset managers collected fees. Record keepers charged for administration. Advisors built businesses around helping workers make choices that earlier pension managers had made on their behalf. The system allowed workers to own their retirement assets directly. Accounts could often move with employees when they changed jobs. During strong markets, consistent contributors could accumulate substantial wealth. For highly paid workers with stable employment, generous matching contributions, low-cost investment options, and enough income to save aggressively, the 401 kilo could perform extremely well. But its benefits depended on conditions millions of Americans did not possess. Low-wage workers often could not afford to sacrifice part of each paycheck. Employees facing rent, medical bills, childcare costs, or debt might contribute little or nothing. Some workplaces offered no plan, others provided no match, or charged high administrative and investment fees. Workers who changed jobs frequently could end up with scattered accounts, interrupted contributions, or withdrawn balances. Those who left the labor force to care for children or relatives lost valuable saving years. Market declines near retirement could damage accounts at precisely the moment workers needed to begin taking income. Even human behavior became a financial risk. People often contributed too little, invested too conservatively, traded at the wrong time, or withdrew money during emergencies. Some borrowed against their accounts. Others cashed them out when changing employers, paying taxes and penalties while sacrificing future growth. The system assumed a degree of financial expertise, discipline, and stability that was never evenly distributed across the population. Even some of the people associated with the early rise of the 401k later acknowledged that it had expanded far beyond its original purpose. Benna himself became critical of aspects of the system, particularly high fees and excessive complexity. The account he helped pioneer had been conceived as an additional savings mechanism. It was not intended to bear primary responsibility for the retirement security of an entire workforce. Yet that is the burden it came to carry. The transformation also changed how Americans understood failure. Under a pension, a company that did not fund its obligations could be blamed for breaking its promise. Under a 401k, responsibility became individualized. A worker who reached retirement with too little money could be told that they had not contributed enough, invested correctly, controlled their spending, or planned effectively. Some of those factors matter. But focusing only on individual decisions conceals the structure surrounding them. A person cannot contribute money that their wages do not leave available. They cannot receive a company match from an employer that offers none. They cannot recover years spent outside paid work. They cannot control the timing of recessions, inflation, medical crises, or market collapses. The retirement system increasingly rewarded those already positioned to save. This produced a striking gap between average and median account balances. A relatively small number of households with large portfolios could raise the average dramatically, even while many people approached retirement with little or no savings. Millions continued to depend heavily on Social Security, despite the fact that the program had always been intended to provide a basic income floor rather than a complete retirement. The older three-part model had not disappeared in theory. In practice, one leg had weakened and another had become deeply unequal. Traditional pensions survived in parts of the public sector and in some private industries, but they became increasingly rare for new private sector workers. Personal savings grew through 401 keys jotted, yet access and outcomes varied sharply. Social Security remained the most universal element even as political debates continued over its finances, retirement age, taxes, and future benefits. The history had nearly completed a circle. During the 19th century, the risk of old age rested primarily on individuals and their families. Industrialization revealed the limits of that arrangement. Social Security transferred part of the risk to government. Pensions transferred another part to employers. The rise of the 401k moved a significant portion back to the individual. The poorhouse disappeared, but the underlying fear survived, the possibility of outliving one's savings, becoming dependent on relatives, or continuing to work after the body could no longer tolerate it. The symbols changed. The drafty almshouse became a retirement calculator, displaying a shortage. The lost corporate pension became an account balance, rising and falling with the market. The moral judgment, once attached to public dependency, reappeared in the language of personal financial responsibility. None of this means the 401 keeper is inherently useless. For many Americans, it has produced financial independence that earlier generations could not have imagined. Tax advantages, employer matches, and decades of investment growth can build substantial security. But the system works best for those able to feed it consistently. That limitation is central to its history. The 401 keeper was not created through a national decision that workers should manage their own retirement portfolios. It emerged from a brief section of tax legislation, a consultant's interpretation, and regulatory approval. Corporations embraced it because it made retirement costs more predictable and transferred investment risk away from company balance sheets. The financial industry embraced it because millions of individual accounts created fees and permanent demand for investment products. Workers embraced it because increasingly it was the only employer-sponsored option available. What began as a supplement became a replacement, and that may be the most revealing part of the story. Every retirement system is ultimately an answer to one question: who carries the risk when a person becomes too old to work? In the poorhouse era, the individual carried it. Under the post-war pension system, employers accepted much of it. Through Social Security, the public shared it. Under the 401 key, the worker carries it once again, this time while navigating financial markets, tax rules, inflation, longevity, and economic crises. The modern system looks more sophisticated than anything that came before it. It offers online dashboards, automated funds, contribution calculators, and thousands of investment choices. But beneath the technology lies the same ancient uncertainty. Will the money last for millions of Americans? The answer will depend not only on how wisely they save, but on wages, health, employment policy, and markets they cannot control. The system that now defines American retirement is younger than many of the people depending on it. It was not designed to become the sole pillar of old age security. History simply placed more and more weight upon it until the temporary supplement became the foundation.